So what I would like to do this morning mainly are three things. Okay. So the first thing I want to do is to just walk you through some of the slides related to convertible bonds, which I wasn't able to do. Now, converted CB, I think, is for this course, for Rose K's part, the trickier portion. So she's given you coverage on IPO and then follow-on offering, on debt capital markets, on convertible bonds, and then on bank capital. Of these, I think CB is probably technically the more challenging, not because we are presenting with you a lot of high-powered mathematics, not because of that, but you do require a certain commercial sense and commercial intuition. So I'm going to try and help you with that. That's number one. Okay, so we're going to go through some slides which are actually from tutorial 5 last time. Okay, that's the first thing. The second thing, I'm going to try and give you a quick summary of what we have learned with Rose, because there's a midterm coming up this Saturday. You do know that, right? You are aware of it. There's a midterm this Saturday. So that's number 2. And number 3, I will tell you a little bit about the midterm and what to expect from there. Okay, so that's the agenda today, 3 things. Now, for the first part, so this deck of slides is already up online in Blackboard, so you can download as you wish, and I will go through parts of it. Okay. So as you know, today is the 7th of February. We're going to meet 3 more times, including next week. And in fact, we're going to meet every Tuesday for this month. There are 4 Tuesdays, and we'll be meeting every week. So after today, we have 3 more meetings. And so we've already presented on 4th and the 5th of February. Okay. The midterm is this Saturday, and next Saturday there is another task. I'll tell you a bit more about all those things in a moment. Okay. But for now, what I like to just walk you through now. These questions I have collected them from, I think, prior to the Chinese New Year, and there have been quite a few. So I knew I wouldn't have time to go through all of them in the tutorial. In fact, these questions have already been answered in a video format. You will find that on YouTube, the Google channel. I think there are around 10 questions. There's a video there which lasts for around an hour. Okay, and I have answered all these questions in detail in that video. So feel free to have a look at it. I think you will benefit from that. In addition, I hope you all received an email from me sometime before the Chinese New Year. Okay. In that email, there is a link, or there is advice about me answering these questions. There was also a file in there which contains a lot of Q&A from students of the previous year. Did you receive that? Yeah. So I think that's very useful for you in your preparation for this coming Saturday. So you get an idea of how what sort of questions were asked before and how I answered them. My advice to you is you look at the questions first, and without jumping straight to the answer, think about it yourself. How would I answer that? Why does that person have that confusion or that query? And then you look at the answer and see if it matches what you think. Okay? But these questions have already been answered. So this one is about equity link. It's about the coupon and the borrowing rate, why there's a negative correlation. Let me come to that part again soon, but this question is already answered. So is this one. So this is questions about bank capital. Already dealt with, and I have some slides here which will help you. These are actually borrowed from banking, insurance, capital course, okay, but they're useful here. The various types of bank capital and what are their characteristics and payment priority. There's a question on what is the meaning of opportunistic issuance? Again, like I said, I already answered that in the video. This is how I like to look at things. When you look at all the transactions that we have shown to you, whether it's Temasek or Microsoft, whether it's Country Garden or AIA, all of these, I think you find a common theme. The common theme with all the companies that are out there raising capital, I think broadly speaking, when you're raising money, there are one or two possibilities. Either you really need the money, and your company is not doing so well, or you don't really need it. Now, what do I mean by that? You don't really need it, but market conditions are good. So that presents you a good opportunity to go out there and raise some cheap capital. That's what I mean, you don't really need it. And if you were to ask me, I think Microsoft is a good example of that, the convertible bond. A case where you do need money, market conditions are not good. I guess Country Garden is a good case for that. Okay, so opportunistic for me means you want to do something. You want to raise some capital, but you are not so desperate for it. And then you see a window because conditions are favorable. You go out there and then you do the deal. That for me is really the essence of being opportunistic. Okay? So this is a question. I don't understand what opportunistic refers to. Okay? Actually, in the video, I go through a lot more detail with reference to this slide here. Okay. There's another one about Basel, which I have answered. I think it's a lot better if you watch the video because I don't want to go through that here. You might just get lost in the arguments. Okay. You can watch that. This one is regarding, there's probably a typo on one of the slides when it says process announcement. It should really be press announcement. And independence of placees and placing agents. When you are doing follow-on offering, there should be some distance between the investor and the people who are facilitating that, so that you don't have a group of people being favored for some reason. Okay, that's the key. That's the key point of that. Now all of these have been answered, and then this one also, okay, was answered in that video. So I'm just showing you what you can expect. This one also. This one is about the concept of green shoe, which I hope by now you know very well. Now, green shoe, the way we talked about it, is mostly referring to the IPO, the company issuing or coming to the market for the first time. You might have noticed that when you were reading all those articles that we gave you, sometimes when people are issuing convertible bonds, they also use the term green shoe. So this question is related to that. Now, so originally, the way Rose Kay described green shoe to you is that in an IPO context, so you tell everyone you're going to sell, let's say 100 million shares, but on purpose you place 115 million. And so on purpose you create more demand than the supply. And if it is not enough, then you turn around and you borrow that extra 50 million. Remember that? You borrow those shares. So the question here is, if you're issuing a CB, how can you borrow an extra? Where does that come from? Okay. Now, my advice to you is, so whether you are borrowing those shares or whether you are creating new ones, for me, that is actually just an operational detail. The point isn't that one. The point about green shoe is not whether it's borrowed or you are printing new securities. The point is this. The point is you create more demand, 115, than your official supply, 100. That's the point. Okay. So where that 15 extra, that extra 15 comes from, I think it doesn't matter too much. Okay. Finally, I also mentioned credit spread, bond floor, and implied volatility. Okay, bond floor I should explain to you. And I will do that in a moment. Okay, now, so that's all these questions which have already been answered. What I would like to do is to give you just a quick recap on CBs that I said I would do. And actually, there is nothing really mysterious about convertible bonds, and I think they are complicated, not because the instrument is complicated, but the psychology behind it can be fascinating. Okay? And I'm going to try and share with you some of those aspects. Now, just imagine a company issuing a normal bond, not normal, okay? No calls, no puts, nothing. And let's say this is what a 3-year normal bond, okay? And let's say they are ordinarily expected to pay a 4% coupon. Let's just imagine that. The CB, all it is the company says to you, well, how about I don't pay you 4%, okay? Let's say I pay you 2.5 instead. So I pay you a lower coupon. And what's going to happen to the coupon that I don't pay you? Well, you know what? I'll give you a call option instead on the stock of the company. That's it. Okay? That's all it is. So CB is they take away part of the coupon that you would be expecting based on whatever is the credit premium, thank you, of the company, and instead I give you a call option. Now it could be that sometimes I take off the entire amount, I take off the entire 4%, so it actually becomes a zero coupon CB. But then I give you a more attractive call option, okay? So that's when you have a zero coupon convertible bond. Of course, you can have different combinations. So, for example, as far as redemption is concerned, you can have redemption at par. You can have what's called premium redemption. Premium redemption means you give me 100, but at maturity, if it's not converted, let's say I give you 103, for example. Okay, so that's a premium redemption. Now the coupon, of course, you can have zero coupon. Yes, you can. Okay, and you can have a non-zero. Non-zero just means you are paying a coupon. Okay, of course. So you get all kinds of different combinations. So you can have zero coupon and redeem at par. That would be like the Microsoft, I think, as I recall. Okay, so your worst case here for zero coupon and par redemption is your worst case is you just get 100. Well, no, that's not the worst case. That's the second worst case. What is the worst case? Worst case is if the company actually collapsed. That's the worst case. Okay, you get nothing. But that apart. Okay, so you get back 100 if it's not converted. So premium redemption zero coupon is okay. I don't pay you any coupons, but actually at the end, I might pay you, let's say 103 or 104, whatever. Okay. Now you can have non-zero coupon. So let's say I pay you $2 every year, and then at the end I pay you 100. Okay. So something like so the above would be sort of 0 and then 0 and 0 and then 100, or 0 0 0 103, for example. Okay, and then here you can have 2 and 2 and 2, and then I pay you, let's say 101, whatever. So the thing I like about fixed income is there are so many ways you can reshuffle the cash flows. It's like Lego, and it's all about discounting. Okay, so you can have these potential combinations. Now, so CB will pay a lower coupon because I'm giving you the call option. And the strike is normally higher than the current price, sometimes by almost a third. Okay. Now, contingent convertible should not be mistaken from the CBs that are issued by corporates, where or the EBs. Okay. Where you buy the bond, and if stock price goes up, you're quite happy, but if stock price goes down, well, you just get back par. Okay. Now, contingent convertible is something different. First of all, these are only issued by banks. Okay. And a COCO actually converts when the bank is not doing well. So a normal CB converts, and the right is in the hands of the investor, and they will convert when the bank is doing, when the company is doing well. Okay, a CoCo is only converted when the issuer is not doing well, and the right to convert is not in the issuer's hand. Okay, you don't have to memorize that. If you understand what's going on, because a CoCo actually contains a put option in it. Here you are long a call, the investor, but for a CoCo you are actually short a put. So when the company is not doing well and share price is going downhill, then at maturity they will, instead of paying you 100, they take your $100 and they put the shares to you. Okay, that's the difference. So make sure you understand the difference between the two. Is everyone okay with that? Make sure you are. Okay. If you, I've said before, if you have an interest to go into, for lack of a better term, let's say wealth management, private bank, high net worth individuals, these, they sell like pancakes. High net worth individuals, they love these things. So you've got to be very, very clear what kind of instruments you are dealing with and what are their risk characteristics and so on. Okay? I guess in the end, better still, my dream would be that you are able to stand up in an interview, in a job interview, and actually be able to talk about these things. You get me? Yeah. Okay. Now, this is a table that also appears in Rose Cave's slide, but I think the boxes were empty. Okay? So I put some details in there regarding how the coupon of a CB is affected by various parameters, such as conversion premium. Now, I don't want you to look at that. Just don't look at that for a moment. Let me try to make it easier for you how you can try and digest a chart like this. The first thing is, I don't recommend you trying to memorize it. Don't do that. Okay? You got a CPU overload if you memorize all the stuff. The thing about bonds, normal bonds or convertible bonds, is when they're issued, they are normally issued at par, issued at $100 or close to $100. Sometimes there's a slight discount, $99.80. So they're issued at par, and it's actually the coupon and the yield that is changing. So if you issue a par, and I say I promise to pay you a 4% coupon, that means the yield is what? 4%, right? But if I only give you a 3% coupon and you still pay par, then the yield is only 3%. That's fixed income. Okay? Now, with CBs, when you look at all these parameters, conversion premium, volatility, tenor, this and that, dividend yield, stock borrowing cost, the thing to remember is this. For these individual parameters, do they actually make the bond more attractive or less attractive? If they make the bond more attractive, then investors are more likely to become interested. Then that gives you some room to lower the coupon. If investors say, oh no, I don't really want to touch this, okay, then you're going to pay up. Okay? It really is as simple as that. Let me give you an example. Let's say the last two, okay, stock borrow cost and CDS liquidity, because this was one of the questions that were asked. Now, you say here, now first of all, what is stock borrow cost? Stock borrow cost is when you want to short sell something. When you want to short sell something, just as a reminder, some of you may well remember way back in August, during the pre-term finance course, I already tried to make a demonstration. So short selling is an integral part. So let's say here's a short seller and they want to short sell some stocks. So the way you do it is you borrow from a stock lender. So they lend you some stocks. They don't lend you money, they lend you some stocks. You go out there to the market, you sell those stocks, you get cash, and then if you want, maybe you put it in a bank account, although nowadays it's not really very meaningful because interest rates are so low. Okay, so that's at the start. And then at the end, now I'm just telling you something that I'm repeating for the third or the fourth time, so you should know this by now. So at the end, so when you sell it, let's say you are able to sell it at the stock price of 85. Okay, so you put $85 into the bank, and at the end, now if you are the short seller, do you want the stock price to go up or down at the end? You want it to go down. Of course you want it to go down because you are going to get back from the bank $85 and a little bit more, okay? And then you actually got to go out there, pay some money to buy the stock back. And then you return the stock to the stock lender. Right now that's short selling in 2 minutes. So all the stock lender cares is that you give them back that piece of paper, that stock certificate. And so if you're able to buy back at 60, good for you. You made $25, thank you very much. Okay, now the key here is this. When you return the stock back, you have to pay a fee. They don't do it for charity. Okay? How much? That's the question. When you borrow something from somebody, you have to compensate them. Otherwise, why do they want to help you? Okay? There's a fee. How much? And there may be a standard for in some stock exchanges for very, very large companies where there is a lot of active liquid trading. Okay, you may be paying something like 25 basis points per annum, for example. Okay, now if the company is very, very small and not actively traded, then the cost of borrowing the stock, first of all, is it even possible? Number one, okay, and number two, because it depends on the availability of stock lenders out there. Some people don't like to lend stocks, or they are not allowed to lend stocks for whatever compliance reasons. Okay, so if it's a very small company, it's not actively traded, then are there people around who would lend it to you? Number one, and number two, at what cost? Okay, it could be very, very high, and this slide here is talking about precisely that. So the cost of me going out there to borrow stocks is very high. I consider that to be an inconvenience, and as a result, I find this CB less attractive, shall we say? Okay, that's the way to think about it. Now, likewise, if you think about, if you look, in reality, a CB is nothing more than a bond plus a call option. Now, a bond, as you know, the key components are interest rate risk, and then there's so that means the just the pure risk-free rate, which can go up and down, okay, and then there's the credit risk premium. Okay, now for the call option, the price of a call, since you are doing derivative markets, you must know by now, can be affected by the spot price. It can also be affected by what else? This fella. Remember that? When you are trading a call option, I'll call up our old friend. You know what screen I'm gonna bring up in a moment, okay? Option. Don't worry about the Israelis, okay? Optionprice.com. When you are trading an option, there's a very simple option here. The exercise price cannot change. Now, I know interest rates can change, but put that aside for a moment, or dividend yields, okay? A stock price is essentially affected by, an option price is affected by either a change in the underlying stock price, okay, or when volatility is changing. So let's say you pump that up from 25 to 30. Watch what happens to the call option. Now it's 357, and then it becomes 414. Okay, that's the point I was trying to make there. So there are different sources of market underlyings that can affect your CB price. Okay, now that brings me to the next point, and the point is as follows. The point is this. Let me just tell you a little bit about how hedge funds actually invest in CBs, and then I'll come back to this slide here. Okay. Now, first of all, I want to draw to your awareness that in any normal CB issue out there, typically, you find that hedge funds actually are very active participants in the CB market. So typically, for any CB, hedge funds would on average account for, let's say, a quarter to 35% of the take-up. So hedge funds are a very important component in the CB investor base, shall we say. Okay. Which means that as a result, when issuers are issuing CBs, they really want to try to accommodate or cater for the hedge fund world. What is so special about the hedge fund world when they invest in CBs? That is the next section. Okay? Now, the way hedge funds invest in CBs are not really the same as there are other mutual fund managers out there. There are some dedicated hedge CB funds that you can buy. Okay, but hedge funds don't invest that way. Sorry, this slide is very wordy. The way I make these slides when I'm sharing with you is different from how I would make slides when I'm doing, let's say, a customer pitch. Don't have so many words. People are so busy reading it, they can't hear you. But this I have to, because I want to give you a lot of details. Okay? Now, the way hedge funds invest are actually very different. They don't just buy and hold. They don't do that. But when a hedge fund invests in CBs, they primarily are interested in the call option, and especially the volatility part of the call option. They are interested to buy a CB and watch this go up and down in order to profit from it. Okay. In other words, when a hedge fund buys a CB, they don't really want to think about what might happen to the stock price. They don't really care. If they did, there's a better place. Just go straight to the stock market and buy the stock if you want to take that exposure. Okay. So they don't want to have to think about this. Sometimes they don't even want to have to think about the credit risk. Okay. So what they do is they try to hedge it away. So the credit risk you can hedge with a credit default swap. And then for the stock price, you can hedge by simply short selling. Because you are long a call. When you are long a call, the call price goes up as the stock price goes up, but then the call price goes down when the stock price goes down. Okay, so if you are short, then as the stock price goes up, you will lose money. But if you are short, as the stock price goes down, you will make money. And these will kind of offset each other. Okay, now that's what hedge funds want to do. Okay, is everyone okay with that? Are you all with me? Sure. Because if you don't understand that part, you have a lot of difficulty understanding a lot of stuff that's been shown to you. Okay, just try and understand that hedge funds are not interested in trading the stock price. So they want to try and hedge that away. And the way they do that is by short selling. It's called delta hedging or delta neutral, as I'm sure you know by now. Okay, which means it's very, very important that they are able to do this in the market. So for a hedge fund, you are Morgan Stanley, BOA, go to a hedge fund and you sit down on the table, give you a cup of coffee, and you want to market a CB. The first question on their mind is, can I short sell this? Okay? Because they want to trade just the volatility component without worrying about the stock price. Okay? So you see in a lot of all these articles, people talk about whether it's easy or hard to short sell. That's the reason. Okay? So if the cost of borrowing or the cost of short selling is very high for the CB investor, is that attractive for them? It isn't, right? So as a result, if you are neutral, what do? You try to pay them a bit more to compensate. Okay? So that's the logic. Okay? So don't memorize this table. Try to reason and understand. Then you don't have to memorize anything. Okay? Now likewise, if the CDS market is very active and very liquid, and it's very easy for you to hedge the credit risk. If you are a hedge fund, are you happy with that? Of course you are. So a high level of liquidity will help you reduce the coupon you need to pay. I think generally high level of liquidity has to be good for anything, anywhere. Okay? It's always good to have liquidity. Okay. Now, I often get asked, if hedge funds like to trade the equity option, why don't they just go out there and buy that call option? Why take the trouble? Why take the trouble of investing in the CB and going short selling the stock and taking on the CDS, going through all this trouble just to trade the volatility? Why do that? You understand my question? Sorry?
At least the hedge funds will get.
At least hedge funds will get the coupon. That's true. And it's a valid point. And it is actually something that some hedge funds would like to have. Now, of course, if you have cash, you buy a CB and they, instead of paying you 4%, they pay you 2%. You get something. So then you can put that cash into another bond or put it in a buy US treasuries. You get substantially less, but you get something. Okay? But it is true what you just said. You get a coupon. Maybe you like that issuer. Okay? There is another important reason. These are things that you might not find in textbooks. That's what I'm just telling you. The other reason is, let's say you so you look at that country garden piece. Okay? The country garden CBA issue. The tenor is like 2 years or 3 years. But sometimes even longer. It is not always possible to buy that kind of option, especially on really, really small companies which don't trade very actively. Now, buying options on small companies is hard enough, number one. Okay? Buying long-dated options is even harder. There is no market for that. Okay? For even really, really big companies like Microsoft or IBM, if you want to trade options, which I frequently do, okay? But I am constrained to trading something between 0 to 12 months. Okay? Beyond that, you really have to go to a specialist like Morgan Stanley or Deutsche Bank or whatever. And still, they might say, okay, sorry, I don't want to make a market of this. Okay? So it's not always available. So when a small company issues a CB, that is a golden opportunity for you to take a position on the volatility of that company, option volatility, okay? And you trade that. And sometimes it could be offered to you at a very attractive level. Okay? So that is why CBs have endured. You want to leave the other one. Yeah. Okay. Now, question: what is a call spread? You should know by now. Do you know what a call spread is? You all okay with that? A call spread, generically, is nothing more than you buy a call at a lower strike let's say it's strike 100, and then so you're long this call, and then you short another one, let's say at a strike of 120. So you have some upside, but then it's capped. Now that's the technical definition of a call spread. You long a call, and then you are short another one. Okay. In the case of a CB issuer, it actually works the other way around, because with a CB, so let's say you are the issuer, okay? So the investor buys a bond plus a call, and maybe the strike is 100. So you are actually short. You are short that call if you are the issuer. So the issuer is short a call at 100, okay? And what they do is they would turn around and privately try to buy a call at 100. So they might do a deal with Goldman Sachs or whoever, and then they sell another one at, let's say, 120. Now that's what's called a call spread. You'd find an example of that with the Microsoft CB trade. Okay, you are okay with that? Okay, so a CB is something like this. All right. So for the investor, in fact, the numbers I use are a little bit different. So with the investor, you sell a CB, and the call option has a strike of 125, but privately, you arrange with the iBank where you buy a call option at 125 and you sell another one at 150. So synthetically, when you add everything together, it would be as if you issued a bond, a CB, but the call option will actually convert at 150. You get me? Because these two will cancel out each other. Do you think the issuer needs to pay for this transaction here? Or somebody will pay them? Actually, the answer is already on the screen. Okay, you need to pay for that because you are buying a call at a lower strike and you sell a call at a higher strike. Okay, now that's a call spread. So that's what a call spread is. The more important part, after understanding what it is, of course, is why do people do that? Okay, why does the issuer, why don't they just issue a CB where the strike was 150? Why don't you do that? Isn't that easier? Sorry? It's not very good. It's not attractive. The reason you would not do that is no one would buy that from you. So the investor says, no, I don't have any interest. I don't think your share price will ever get that high. Okay, so they wouldn't buy that. So if you are the issuer, you want to do two things. Number one, you want to issue a CB that people will buy. So you have to lower the strike. But number two, this isn't really the strike that you want in the end. Okay, so you come to the iBank and then ask them to help you out. That's the function of the call spread. Okay. I really think sometimes finance is very neat, and you can see here everybody is happy. So the investor is happy, the issuer is happy, the iBank is happy because they get made some fees, and everybody's objective. Everyone's objectives are satisfied. Okay. There's a real example that I'm quoting here, a company called Symantec. which you may or may not know. So they used to be, don't know if they're still around, but they make this Norton antivirus software. And they had precisely that situation. And then they did a call, they did a CB, and then they turned around and they did a call spread. Okay? Now, equity swap. So you need to understand what that is. The easiest way is just to look at the diagrams. An equity swap is simply when two parties agree to exchange with each other cash flows, where one party will pay an interest rate and the other party will pay the performance based on the stock price of a particular company. So if that stock price goes up, counterparty 2 will pay, but if the stock price goes down, counterparty 2 actually has to pay a negative amount. In fact, counterparty 1 has to pay. Okay? Now, that's called an equity swap. This is just it's a very simple equity derivative, which is the same as if you run a trading desk, an equity desk, and you want to take a position on something. And you don't have any money, okay? You don't have any money, all right? And so typically there are two ways you can do it. You can turn around, so let's say you are BOA, you turn around, you go to the HSBC, say, oh, can I borrow $20 million, please? And because you are BOA, they will say, yeah, no problem. You borrow some money, and then you turn around and then you buy some stocks. That's how trading desks actually finance themselves. It's all based on zero balance to start with. That's one way. Okay. Now the other way is to do something like that. You guys get together and you form a private transaction where I will pay the borrowing cost and I get the performance. The economic result at the end actually is almost identical. Okay? So don't think an equity swap is very complicated. It isn't. It's just a way of leveraging. And it's almost like you go to the same party to borrow the money, and then you pay back the money to them to buy the stock, and then you hold the stock, and then of course you get all the performance. Okay? But without involving any payments or any physical actual ownership, okay, you have a private transaction between the two of you. Okay. Now, the equity swap actually is part of is one important aspect in the country garden trade, and I want to see if I can try and tie this up for you. Very quickly. Now, the country garden trade was like this. So ideally, when you are a hedge fund, again, I use the hedge fund example. When you look back at the country garden trade, okay, first of all, let me try and describe what happened there. You haven't read it. The country garden case was a transaction where the company tried to issue a CB, number one. You do all know that, right? And they want to take care of the interests of hedge funds as usual. Okay? So they want to make sure that hedge funds are well looked after, which means they want to make sure that hedge funds are able to short sell country garden stocks if and when they buy the CB. Okay, that's the number 3. And number 4, they try to help on that, but not directly, indirectly. Okay, so they asked Merrill Lynch to help the hedge funds. Merrill Lynch said, okay, we'll help them. And then Country Garden behind Merrill Lynch said, okay, I will also help you. So you face the hedge funds and I face you. Okay? So that's what really happened. And you will see that in the following diagrams. So ideally, when a hedge fund is buying the CB, they just want to be able to go out there and borrow some stocks from investor X in order to short sell. That would be the easiest way, okay? And in Country Garden's case, what they wanted to do was to provide shares to hedge funds so that hedge funds can do the short selling. So they want to be this investor X party here, okay? So Country Garden wanted to play that role. Now they couldn't, because I think that meant they had to get a lot more shares in order to lend them to the hedge funds. So what they did was, Country Garden said to Merrill Lynch, they said, why don't you help me lend the shares to the hedge funds, and then I'll try to help you out. And Merrill Lynch says, okay, yeah, we'll do that. So Merrill Lynch will get some shares from the market in order to lend them to the hedge funds here, okay? When you are lending shares in this manner, one day the hedge funds will need to pay you back, as I highlighted to you earlier, up here, okay? So when you are lending shares, you still have the exposure on those shares. So Merrill Lynch here would have an exposure on these shares unless something was done about that, okay? So once you buy the shares from the market doesn't care about you, okay? So what happened next was, Country Garden said, okay, not a problem. I know you have a long exposure. So here you are long Country Garden, okay? So how about privately, you and I do another trade where you are short. So here Merrill Lynch is short and Country Garden is long. Now this is the equity swap, okay? This is the equity swap. And everything now falls into place. So the hedge funds are happy because someone is lending them shares to sell. Merrill Lynch is happy, so they took on some shares from the market, but now they have a hedge. And Country Garden is happy because they managed to sell the CB, and then they took on a direct long exposure of stocks from their own company. Now that is the actual mistake that so many people are referring to, that they lost so much money because now they are long their own shares, and as the share price fell, it had a very major impact on their P&L, which would then impact the share price, which would then impact the P&L, and it just went round and round like a circle, okay? That was what really nearly sank them, okay? I strongly recommend you try and get familiar with this trade. Even if you want to discuss it after the midterm, I'm very happy to do so, okay? You should take a look at this because it's such a classic transaction. You should learn it not for the exam. Forget about the exam. You should learn it just as part of your development to be a professional banker. I think it's a very, very interesting trade. Okay, so I've done my best to dissect the trade and put it in and give you the actual structure. All right. Now, some of you were asking about a certain spreadsheet that I think Rose Kay was knocking out during her final lecture. Do you remember that? The various asset classes or various financial instruments and what are their attributes. Now I've reproduced the that spreadsheet, so this is now online, but this is still tutorial 5. It's from last week. Okay. Yes, sir. Oh, sorry. Yes, madam. Okay. I didn't know who you were. Yes.
For the country garden case, if the country garden itself does not cover the exposure Merrill Lynch case, so the country garden has any other alternative that could provide a better conditions that it is at the moment. Had it not taken the exposure Merrill Lynch Merrill Lynch had when Merrill Lynch was purchasing the shares from the market, would there be any other alternatives or any other options country garden could have to also finish the deal of the
Okay. She asked a very good question. She was asking me if you, in case, okay, please let me know if I didn't hear you correctly. She was asking, in this event, Country Garden was the one who provided the hedge to Merrill Lynch, because like I said, over here, Merrill Lynch went long, so here they need to go short, and then Country Garden helped them out by taking a long position itself. And her question was, is there no alternative? Does Country Garden really have to be there? Is that your question? Okay. Do you all understand the question? Okay. Now, it's an interesting one. I think a case like this is a classic example of how even the owner or senior management of a company, any company, okay, can often get things wrong. Okay, so I think they did that for 2 reasons. I speculate they did that for 2 reasons. Country Garden, reason 1 is Country Garden itself was very positive on the share price. So they actually, so that is to a great extent essentially a speculative judgment. Okay, so they were, you don't often see companies do that, okay, but they did, number 1. And number 2 is that if Country Garden did not provide a hedge here, okay, what Merrill Lynch would have to do is they would have to go out to the market and they would need to create a short position elsewhere with the market instead of privately with Country Garden. Now, when you do that in a market, that can create some selling pressure or downward pressure on the stock price. Okay, but because this is a private transaction, there will not be any selling to the market outside. So this actually ends up reducing the downward pressure on price. Now, I'm not saying that Country Garden was right to do this. I'm just trying to explain what was probably going through their mind. Okay? So the question, if the question is, did they really have to do that? No, they don't. Okay, but they went ahead and did it anyway. Last time somebody actually asked me another very meaningful question. You actually often find, in the case of CBs, you find that frequently the issuer, like I said, will try to help hedge funds facilitate their short selling. So the question that was asked to me was, why would the issuer want to help them? Because when there is short selling in the market, it's going to put some downward pressure on your stock price, which that's not something that companies want to see. Why do companies help them? Okay. Apart from wanting to sell the CB, apart from that, why do companies want to help? What is the incentive? Now, the answer is, this is how hedge funds trade, and issuers understand that. So the end result is, if I'm the issuer, if I don't help them, they will go and do the short selling somewhere else anyway, okay? So there will always be some short selling. So if I'm able to help them, in order to reduce that pain or reduce that downward pressure on price, why not try and do that? And that's probably one of the motivations also behind what Country Garden was thinking. Okay. In fact, that's kind of point number 2, isn't it? All right. Now let me quickly switch to the tutorial file for this week. So there are some housekeeping stuff I want to just remind you. So first of all, so here's the calendar. Now for the March presentations, I guess this is not something you need to worry about right now, but I have published the presentation also, so you now know what you need to work on. All right. Now this, thank you. This file is already online in Blackboard, so take a look at that. Give you a little sticker. So don't worry about that for now, because you've got a month to do it almost. Okay. There was a question. Good afternoon. Can you please explain further why dividend pass-through structure is better pricing terms for the issuer, since conversion price will be higher when dividends are higher? No, I wouldn't. You don't have to worry about the conversion price. And conversion price doesn't change. First of all, the dividend pass-through is this. Now, mathematically, all things being equal, when the dividend yield of a company suddenly goes up unexpectedly, when that happens, what normally happens to the price? All else being equal, mathematically, or at least the forward price. Now you know that the forward is equal to the spot compounded up. I've already written down the answer here. Okay. So when the dividend yield goes up, the forward price will fall. It's a little like saying, if a company is worth $100 million, that is the market cap, suddenly I decide to pay you $10 million dividend. Well, yeah, of course, now the company is only worth 90 million. That's all it is. Okay, so when the dividend yield goes up, the forward price will drop. Now, if you are long a CB, so you're long a call, then as the dividend goes up and the price of the stock goes down, I should use S actually. or F. As the forward goes down, you're not really so happy because your call price will also go down. Okay, so as a compensation, the dividend pass-through, what they do is they try to compensate you. Okay, now there are two ways. So typically, number one is they adjust the strike price of the CB call. Do they adjust it up or down, you think? You want the adjustment to be, the strike to be adjusted up, or you want it to be adjusted down? So if the original strike was 100, and suddenly they paid a whopping big dividend, and then the stock price falls substantially, do you want there to be an adjustment to the strike, an adjustment up or an adjustment down? You want a strike price to be lower, don't you? You have a call option. Why do you want the strike to be high? Of course you don't, okay? So that's the first way. Now the second way is some kind of monetary compensation. So if ordinarily the dividend yield is, let's say, 2.5%, but suddenly they decided to pay 4%, then they would promise to compensate you part of that as a bondholder. So that has to be written into the contract. So that makes you feel a little bit better. Okay. Now, all of this stuff, all of it is for one purpose. If you have a dividend pass-through structure, what is the purpose? The purpose is to make your deal more attractive. Okay, is to make your CB more attractive. And if your CB is more attractive, that just means the issuer has some room to reduce the coupon. Okay, that's all it is. Now this is what I was saying to you like half an hour ago. A lot of it actually comes back to this very, very simple theme. Okay, so you just look at that chart that I showed you here, this one. Okay, you look at all of these things here. You ask yourself, okay, when a conversion premium goes up and down, if I'm the investor, am I happy? Am I happier or unhappier? When volatility goes up, or tenor, or dividend yield, does that make me happy or not? If it makes me happier, then I am happy to consider a lower coupon. Okay? Now, as to this part here, okay, so what do these symbols actually mean? It's very simple. The way you read them is you read this part. So this is a 5 put 3 non-call 3 at 130. That means you issue a CB, which is 5 years in tenor and puttable by investor in year 3, but one time only, one time put. Okay, and this NC3 part, it stands for 5 put 3 non-call 3. So the first 3 years you cannot call, okay, but it's callable after 3 years. So that's what that means. Now likewise here, this one is a 5 put 3 call 3. So this one I think is at the 3-year point, either there is a one-time put or there is a call, there's a one-time call in year 3. Okay, but don't worry too much about these things. All right. Now I'm going to just give you a very, very quick review of the midterm. I'm not going to talk about the VIX. I might do that next time. Some of you are asking me questions about the VIX and CBOE. I love talking about. I get very excited every time someone starts talking about the VIX. But today we don't have time for that. I do want to just go through very quickly. So you must know by now that there have been 5 major segments. What Rose has been going through with you. So there's equity, there's ECM, the initial public offer. So here's a checklist of things that I think you need to know. I have some questions here. Now the best way for you to revise is you look at these bullet points. Now I don't say that is the whole list, okay? But I think you should at least know these things. And then you can ask yourself these practice questions, see whether you can answer them. Unfortunately, there isn't really a textbook that you can use, but I think, to be fair, if you had paid attention in class and you understand not just the notes that Rose was providing to you, but you also understand the things that she was talking about, you shouldn't really have any difficulties in midterm. Let's take question 7. What is the difference between cornerstone investors and anchor investors? I can well imagine a question like that coming up, okay, in the exam. It's fair enough, right? We have told you what that is. It's a simple question, and it's something that we already shared with you. Okay. Now, likewise, for follow-on offer, make sure you are comfortable with these bullet points and these questions. I don't think we covered private investors, so don't worry about things that do not appear in the notes. What is a creeper's rule, for example? Okay? It's a fair question to ask you. And with or without a textbook, I think we have talked about that enough for you to be able to answer it. DCM, things that you should know. What are the pros and cons of issuing bond versus equity, bond versus loans? Equity link. What the hell is a call spread? Well, I just spent 10 minutes telling you that. Okay. What is a tax call? What is an investor put? How do investors hedge credit risk and equity risk? You know what? You know more than you think. You have learned far more than you think, just by us talking to you and sharing with you notes and tutorial slides and so on, okay? In fact, I put all these questions down because if you had been paying attention in class and in lecture, you would be able to answer all of these, okay? All right. Bank capital and reform, I think is a minor aspect of this course. Now, for the midterm, it will be this coming Saturday, and it's going to be 10 a.m. We'll open the door earlier. It's in CYT LT1, the really big one. We will knock out a seating plan. Now there will be two sections of questions: the what questions, the why, and the how. And give you an idea what the exam might look like. So section A, there will be, I think, 5 or 6 like subsections with questions on IPO, questions on follow-on offering, questions on bonds, and on CBs and bank capital and so on. And now question A, you must answer. Everyone has to answer. And question B, there's B1 and there's B2. The formats are similar, so there are subsections, but this time the difference is you can choose. You can answer either B1 or B2. Don't do both of them, okay? Or don't pick and choose from different parts, then I don't know what I'm gonna do. Just answer either B1 or B2, please, okay? Is that okay with everyone? Yeah? I would advise you to pace yourself. Now, what I mean by that is, if you see that there's a question which is worth, let's say 5%, let's just say, okay. So the whole exam is 120 minutes. So 5% is equal to 6 minutes, for instance. So if I ask you a question and I give you 6 minutes to do, and you find that you were able, or you spend 20 seconds on that question, or you give me some kind of yes, no answer, okay, then I'm sorry. I guess a high quality answer gets a high quality score. Now, I shouldn't have to say this, but I wanted to tell you this even after the IPA exam last term with Professor Fong, okay? From what I can see, students' answers, typically there are 3 types of answers. Type 1 is we give you a lot of space and time and you just write a couple of lines. Type 2, we give you space and time and you write a lot, but a lot of it is irrelevant, okay? You just want to kind of hope to fool the examiner that they don't notice. Type 3 is you write a lot of substance and it is all relevant, okay? Now, this is what we're looking for. We're not looking for that, we're not looking for this. Now, between these two, I don't know which is worse, because for the second one, I actually have to look through it. I have to read it and then decide, okay, this is not relevant. The other thing I can say is, if we ask you a question, and the question may have a yes or no answer, okay? Please don't just say yes or no. You know, what would be an example? Let's take question 5 here, okay? If an issuer wants a higher conversion premium, do they need to pay high or lower coupon? First of all, what is the answer? If investor wants a high conversion premium, if the investor wants to sell a CB, let's say, okay, instead of a strike of 125, let's say they want to sell a CB, but strike was 140, let's just say, okay, and for a CB at 125, let's say they pay a 2% coupon. If they want to sell a CB, same issuer, same tenor, would they need to pay more or less? They need to pay more, right? Because this is less attractive. So maybe this. Now, this is a very typical example. When I ask this question, quite often the student will just write higher, okay? That's it, one word. Now, we're not in Macau, okay? We're not running a casino. So, the purpose of these exams and tests is to, I guess, give you an idea to demonstrate your understanding and your ability to apply what you have learned. And if you ask me that question, Sam, do they need to pay a higher or lower coupon? And I just say to you, oh, higher, okay? Are you satisfied with that? Of course you're not. The next question you will ask me is why, okay? So, you know, it's the same with these exams. The what part is easy. Do you know what separates, I think, the amateur from the professionals? Do you know what I think? The amateur investors, they know a lot about what. What is this? What is that? What is a call spread? What is a CB? What is an equity swap? The professionals, they know why you do something, and they know how it's done. That is the difference, okay? So try to put in a bit of explanation and don't give, you know, sort of one-liners or, you know, single word answer. Yes, no, up, down, in, out, higher, lower, okay? I don't know if you really understand or not, and it's very hard for me to give you points. Okay? Now, so this is the conclusion for today. Now, I thought I had a couple more slides. I do want to tell you, let me just go to the PowerPoint of, not this one, not this one. Oops. I want to just give you some advance notice that next week, so next Saturday, I don't know if the slides are here. This one I want to show you, okay? So next week, on Saturday, there will be what we call a real-time case study. So what Christy is going to do is he will give you a case that you haven't seen before. So you've got to read through the case. It will be some like the cases that you have been handling, Harley-Davidson or CBOE. And then he will ask you sort of interpretive questions. Mostly they will not be just factual stuff, but you just look at it and you copy. It wouldn't be that, okay? For that one, you may need to bring a calculator, just for really simple calculations. For this Saturday, you don't need a calculator. Everyone is okay with that? You are aware that there is this event happening, right? Okay, I think I will stop there and let you go. Do you have any questions you want to ask me at this point? Anyone? Feel free. Don't be shy. If you don't have any questions, may I have the answer sheet back? I have recorded this tutorial just now for the last 90 minutes. I'm going to put it online, so you can have a look at it if you want to. So later on today, it'll be on YouTube. Okay. Thank you, everyone, and have a good day. Thank you.